Imagine this. You wake up tomorrow, check your bank account, and there's money sitting there without you working a single hour. No boss, no alarm clock. Just companies like Commonwealth Bank, BHP, and Telstra quietly sending you money simply because you own a tiny piece of them. Sounds like a fantasy, right? But it's real. It's called living off dividends. And today, I'm going to show you the exact number you'd need to make that a reality here in Australia. The real number, not the fake Instagram guru version. Stick around till the end, because I'm also going to show you the mistake almost every beginner dividend investor makes, and you'll probably guess it wrong. Let's say you're a normal person like most of us. You've got a job, some savings, and you've heard people talk about living off dividends like it's some rich person's secret trick. It's not a trick, it's just maths. But nobody ever sits down and shows you the real maths. So let's do that together today. Let's take an example. Sarah. She's 34, lives in Brisbane, and she's tired of the fact that her income only comes in when she shows up to work 5 days a week. She wants an income that comes in whether she works or not. That's exactly what we're going to build today, on paper, step by step. But first, a quick refresher. What dividends actually are, not the boring textbook version. When you buy a share, say in a big bank, you're literally buying a small piece of that business. And here's the good part. Profitable companies share their profits with their owners. That's you. That payment is called a dividend. Now, Australia has something most countries don't: franking credits. In simple terms, if a company has already paid tax on its profits and then pays you a dividend out of those profits, the tax office gives you credit for the tax already paid. The government is essentially saying, we won't tax this twice. That's why Aussie investors talk about grossed up yield, meaning your dividend plus the tax credit added together. It's genuinely one of the biggest perks of the Australian share market. Now, the part you actually clicked for. Let's do the real numbers. Right now, the Australian share market, the ASX 200, gives an average dividend yield of around 3.3% in cash. But once you add franking credits, it grosses up to somewhere between 4% and 4.5% for most investors. Let's say Sarah wants $50,000 a year in dividend income, which is enough for a modest but comfortable lifestyle outside the big cities. The formula is simple. How much you need to invest equals the income you want divided by the dividend yield. So at a 4.5% grossed up yield, $50,000 divided by 0.045 comes to roughly $1.11 million that needs to be invested. Yeah, I know, that number probably made your stomach drop a little, but don't close the tab yet, because this number changes a lot depending on what you actually invest in. I'll show you that now. Some Aussie investors don't settle for the market average. They build what's called an income-tilted portfolio, focusing on established, high-yielding companies. Take the big banks. NAB and Westpac currently offer around 4.3% to 4.5% cash yield, fully franked, which grosses up to somewhere between 6% and 6.5%. Or a minor like BHP, which analysts expect to yield around 5% in cash, close to 7.5% grossed up with full franking. If Sarah built a portfolio averaging a 6.5% grossed up yield instead of 4.5%, the maths changes completely. $50,000 divided by 0.065 comes to roughly $770,000 that needs to be invested. That's $300,000 less than before. Same income, less capital required. So why doesn't everyone just chase the highest yield they can find? Because this is exactly where beginners get caught out. It's called a yield trap. When a stock's dividend yield looks really high, 9%, 10%, 12%, it's often high for a bad reason. The share price has crashed, and the dividend is about to get cut. The result is a portfolio that looks great on a spreadsheet, but terrible in real life. because your income and your capital both collapse at the same time. Sustainable dividend investing usually sits in that 5% to 7% grossed up range from genuinely strong businesses. If you see a yield way higher than that, ask yourself, what does the market know that I don't? Now, here's a question I get asked constantly. Do you actually need to go out and pick individual stocks yourself? And honestly, for most beginners, the answer is no. There's an easier way, and it's how a lot of everyday Australians actually build their dividend portfolios. It's called an ETF, an exchange-traded fund. Think of it like a basket that already holds dozens, sometimes hundreds, of different shares bundled together. Instead of picking NAB or BHP individually and hoping you got it right, you buy one ETF, and instantly you own a small slice of the entire basket. Something like an Australian dividend-focused ETF automatically spreads your money across the big banks, the miners, and other strong dividend payers. So if one company has a bad year, you're not wiped out because the others balance it. This is genuinely one of the simplest ways to avoid falling into that yield trap we just talked about, because the fund managers are doing some of that quality filtering for you. Setting this up is a lot less intimidating than people think. You open what's called a brokerage account. There are plenty of Australian platforms built specifically for this. You verify your identity, link your bank account, and you're able to start buying shares or ETFs with as little as a few $100s. No suit, no meetings, no minimum $1 million entry ticket. And here's a feature worth knowing about. It's called a Dividend Reinvestment Plan, or DRP. Instead of the dividend landing in your bank account as cash, you can set it to automatically buy you more shares of the same company or fund. This is exactly how that compounding snowball I mentioned earlier happens automatically in the background, without you lifting a finger every quarter. One more thing before we move on, and this one's important. Never put all your money into one single stock, no matter how good it looks. Even the big four banks, even BHP, can have a rough year. Spreading your investments across different sectors, banking, resources, healthcare, infrastructure, means your income doesn't collapse if one industry has a bad run. Diversification isn't about playing it safe out of fear. It's about making sure your future income is something you can actually rely on, year after year, no matter what the market's doing. Look, I don't want you to think this is only a rich person's dream, because here's the truth nobody tells you. You don't need the full $770,000 or $1.1 million on day one to make this work. Every dollar you invest today is already earning you a small piece of your future income. If Sarah starts with $20,000 and adds $1,000 every month and reinvests every dividend along the way, compounding does something amazing. Because your dividend buys more shares, which pays you more dividends, which buys even more shares. This is genuinely how most Australians who eventually live off dividends actually get there. Not by dropping $1 million all at once, but by consistently investing for 15, 20, 25 years and letting the snowball effect do the work. The number isn't the scary part. Time is actually your biggest asset here, more important than the size of your first deposit. So here's what I want you to take away from today. First, figure out your number. Take the annual income you want, divide it by a realistic yield, somewhere between 4.5% and 6.5%, depending on how much risk you're comfortable with. That's your target. Second, don't chase the highest yield, chase the most sustainable one. A company that's been growing its dividend consistently for 10, 15, 20 years tells you more than a flashy 9% number ever will. Third, franking credits are your best friend as an Australian investor. Understand them, because they can significantly boost your real, after-tax income compared to markets where franking doesn't exist. And fourth, you don't need the whole number today. You just need to start and let time and consistency do the rest. Living off dividends in Australia isn't a fantasy. It's just maths, patience,
and choosing quality over flashy numbers. If this video helped you understand the real numbers, hit subscribe, because in the next video, I'm going to break down the exact ASX stocks that combine the best yield and safety, so you don't have to guess where to start. See you in the next one.